Hey everybody, welcome to With Well Anderson, where we talk about finance, we talk about economics, we talk about business issues in plain English. Let's get right to it. Today we're going to talk about what is an IPO versus what is called a D.P.O, which is direct public listing, or you may just hear it as a public listing. Same thing. Anyway, let's talk about what an IPO is. And let's start with history. The first IPO was founded in 1604 in Holland, and it was called the Dutch East India Company. Now, not only was it the first IPO, but guys, hold on to your seats. This was the biggest company in today's dollars in the history of the world. It was 5 times bigger than Apple. 5 times bigger than They controlled the trade in spice, silver, and gold for about 40 years. They were a monster company. So, now, let's talk about some other companies that were IPOs that didn't make that scale. There's AT&T Wireless, there's the Bank of China, there's General Motors. But there's been some losers also. There's been Vonage with voice over IP that suffered all types of legal problems. And Petscom, where you probably remember that irritating pet. I think the pet made more money than Pets.com did. We worked under Anna Newman, which SoftBank had to bail them out. They spent money like it was going out of style. And also problems with IPOs that you might have is it may be underpriced or overpriced. And depending upon which one it is, you can win, you can make money or lose money, depending on what the IPO is. Okay, so why do people use IPOs? Well, the principal reason they use it is to fund a project, expansion, marketing, and to reward the initial investors. And with the company, there's basically really 2 ways you can take it once it's founded. You can take it private, where you can go out into the loan market and just grow your company through loans, which is a lot slower, or you can go through a process like the IPO process. And where that begins is after your concept is ready. Like any other business, you're going to do a friends and family round where you're going to get initial money in from friends and families. You're going to do an angel round where someone's going to come in and actually give you the money to put together the concept. And then you may go private placement, or you may go venture capital. That's up to you. But at some point, in order to go IPO, you have to involve an investment bank like a Goldman Sachs or a Morgan. And what they do is they'll do the due diligence process. Due diligence to make sure that what you were told is true. They will do something called a book building process, where they will go out and interview the large firms and potential buyers of this IPO and get a flavor for what the pricing would be and what the volume would be. They do that for you. They have worldwide contacts. They're able to take on buy some of the stock prematurely to assure the success. IPO wins with Apple, US Steel, Alibaba, and Saudi Aramco was the largest IPO. The advantages in the IPO, you get the large investors, you get the pension funds, you get the high net worth individuals. The due diligence process is done. The early investors get rewarded, but there's usually a lockdown period they have to wait. Some of the negatives is the lockdown. It does take a great deal of time to do an IPO, usually 6 months. And the issue with an IPO is that it is dilutive. Very diluted. Now, we're going to talk a little about direct listings. They vary and interlap and interlope over into what an IPO is. The first direct listing that I know of was done by Ben & Jerry's, the ice cream company in Vermont. They advertised in the newspaper and they raised $750,000. That's what they raised. We're being told that direct listings should be done for companies that aren't that large, and the best way for a larger company to do to come to market is through an IPO. We'll talk about that in a minute. But that's the general attack on IPOs is cost and time. With direct listing, you have to do the book building yourself. You have to go and figure out what kind of price you're going to market without the help of an investment bank. You're going to have to do the marketing. You're going to have to go out there and make sure that people know this is coming out and having them ready and having all the firms, the financial investment bankers behind you. You're going to have to do due diligence to make sure that the numbers are right. You're going to have to deal with the regulatory agencies and things of that nature if you do a direct listing. And if you're a famous name like a Spotify, that might work for you. But if you're not well known and you don't have the contacts throughout the world and you don't have a channel to make sure that the first day when your stock trades, there's a specialist or there is a sponsor on the floor to protect your stock, you gotta be worried about all that. But the bottom side is, on the good side, you're gonna save a lot of money. You're gonna reward the stockholders. It's non-dilutive. What I mean is the stock you buy is the stock that the company is the individual companies own. They're selling their own stock. They're not producing a secondary stock, which can be done, but typically it's not done in direct listings. Let me thank you very much for your time. I appreciate you tuning in. Please give me a like and please subscribe. Thank you very much and have a good day.